Put together the numbers we got this week. The CPI sort of pointed one way, PPI pointed another way at the end of the week, with the sort of enthusiasm coming out of December. I mean, where are we at this point?
Yeah, so it's really interesting. We launched in December our outlook for 2024, which is called Slow Then Grow, Investing in the Market's Big Reset. And I think what we're seeing in the data, it's very interesting. The market overreacts to a lot of the data, just like we saw in December. The market got a little ahead of itself in terms of pricing and rate cuts as soon as March of this year. But really, when we look through the data, I think there's a couple of things that still hold true. So inflation this week. We had CPI, people reacted to that coming in hotter than expected. But where did it come in hotter than expected? It was in shelter. And so shelter naturally has that lag in flowing through into the data, which basically is really reflective of something that happened 6 to 12 months ago, not the present state of home prices. And so when we look at a measurement that's called Supercore, which is actually stripping out shelter, you're at about 2.2%. So there is a clear trajectory in inflation down to about 2.5% in our view by the end of this year. And the PPI data that we received actually reinforced that. That ultimately is going to flow through to consumers, which is actually kind of points to more of a disinflationary environment ahead.
So what does that tell the Fed at this point? Does it need to cut? There's a lot of anticipation of cut, whether it's in March or it's in May, where it's going to be. But as you look at the numbers, are the numbers telling the Fed, yeah, there's really an imperative to cut at some point?
Well, this is where I think the market, as I mentioned, it did get a little bit ahead of itself in December. We saw a rally in the equity market, but we also saw that pricing of a rate cut move up into March. And so the Fed has, as I always say, it has a dual mandate. It's simple, not easy to execute on, and it's inflation and full employment. And so we've seen that resiliency of the U.S. economy. We've seen the resiliency in the job market. However, we have seen jolts come down substantially. We have seen the fact that for them, that with employment remaining strong, they're going to keep an eye on inflation. They're going to look at this data. One has to give before you ultimately get to that first cut. One of the things that I think is beneficial to that story of the rate cuts is the fact that when you actually look at consumer expectations, they're coming down and much more normalized. So when we talk about investing in the market's reset, there's also this kind of normalization. There are a lot of distortions that came into play in prior years. This normalization creates some interesting opportunities.
What are you hearing from clients? What are they focused on? What do they want to know from you?
They want to know about the first rate cut, absolutely. I think the other interesting thing that's happening is a shift where right now there is that concept of last year was about hard landing, soft landing, no landing, inflation, the health of the consumer. This year you are seeing a shift into more geopolitics and into elections. So when we look around the world, you have so many major elections that are going to happen in 2024. It's about equal to about close to 70% of the global market capitalization is going to have an election in their country. So I think we may move away from this constant focus on a recession. That's something in our belief that happened in the past. So one of our big calls this year is that we're going to see no landing. The recession that everyone was anticipating was something that already occurred, and we saw it in profits. We saw it in manufacturing. Earnings actually troughed last year. And so there's a lot of kind of positive outlook for investors.
That's what I was going to ask. Where are we with earnings going to 2024? Because it was pretty modest in 2023.
Yeah, it was very concentrated, obviously, within the Magnificent Seven. And you can see that dislocation between the valuation, where if you strip out those kind of Magnificent Seven, you can see the rest of the U.S. equity market essentially at a 45% discount. But what we saw last year, if you look at Q1, Q2, we were in profits recession. Q3 was really where we began to turn a corner. This idea of a broadening out of the rally, because we've hit peak inflation, because we see interest rates coming down, that means that you can actually expand profitability into other sectors. And so we see earnings growth of this year around about 5%. So not knocking it out of the park, but a markedly different story in that concentrated story that we saw last year.
Profitability into other sectors. If you were going to pick one, what would you pick?
Oh, that's a tough question, but I'll give you an example. I actually think we're going to see a broadening pretty much across sectors, but one of the areas that I will mention is healthcare. Healthcare was a story last year that was really concentrated in two companies, and it was all about GLP-1s, and it was all about
how much we weigh, right?
It was all about, which, trust me, from an innovation standpoint, was really remarkable. But I think when you look at that particular sector, there is a broadening out story. Again, going back to interest rates coming slowing down, M&A activity that we're seeing, an expansion into biotech and med tech. These are areas that were not loved for the majority of 2023, and a really compelling story to invest today as well as for the longer term.